complains that they missed anything, I'll refer them to the recorded session. As you can see on the screen, today's session is on equity modeling, pre-money and post-money. And as usual, I'll try to explain all I know, backed with some experiences, and then I'll also use resources that I have, from people more knowledgeable than me on these terms, on these issues, especially when it comes to pre-money and post-money. The equity modeling, what I know is really, really good because I've done it for a lot of companies and all. The pre-money and post-money, because the startup side of it, so usually there is the aspect that beyond my own knowledge. So luckily, I also have resources of people who that's what they do. So I'm going to also take us through all of what they've said, and hopefully we will all be getting the best, not just opinions. All right, so let's start with equity modeling. In fact, I have prepared a structure that we're going to follow. So the structure we are following is, number one, what is equity, right? So typically people, well, I don't know the category you guys in my audience right now fall in, but then because I know other people watch the video, so allow me to still go ahead with the generalization that I know a lot of people who still don't really get that there's a difference between equity and what the value of their company is. And those who even know, sometimes they can't explain in very, very clear terms, or they don't really know mathematically where those differences lie. So let us start with what is even equity, right? Let me bring up a writing material on my device so that as I'm saying it, you can be able to plug along with what I'm writing on the screen. So what is equity? Let's forget about some high-sounding words. Equity is purely the money put into the business by investors. Or which I'll put owners. But then, just to be technically correct, I'm going to just say equity investors. But then it looks like tautology. Why am I putting the very word that I'm defining inside the definition? It's because, well, some people can claim that when a bank borrows you money, they are also part owners in the business. So, but typically, generally, when we talk about investors, we mean people who are not giving you money as loans, right? So permit me to just leave it there. Leaving it there means, I don't know, whoever is watching the screen should also be hearing my voice, so they should understand that I've explained the reason why I'm just adding the equity in this word. Okay, so now this is it. Practically, people who put money in the business are equity owners, right? And the money they put in is the equity. Now, this equity can go up, can increase, can go up, and also can go down. And why? It's because of what we call retained earnings. So if you put your money in a business that is profitable, right, whatever profit the company makes at the end of the period, let's say it's a year, if you put in 100 million naira and the company made a profit of 50 million naira, then that profit becomes added on top of your original money. And so you see that the equity keeps growing, right? Naturally, the equity keeps growing. So the nice thing is that this equity we are talking about is always captured. It's always captured in the balance sheet. So this is always captured in the balance sheet, right? Okay, so that is the equity we are talking about. The equity we are talking about is very fairly easy to compute. Even if you don't want to compute it, it's something that once you ask for the company's financials, you will always see it there. You will always see it in the balance sheet, what the equity is, okay? And so you can be able to look at it maybe over a period of years and know whether the people who own that equity, the investors, the owners of that businesses, has their equity been growing? So you hear terms like return on equity, and such like. Has the company been growing, or the company has been loss making and having to be depleting the original founders' money? But then let's not go too far off the framework I want to explain all of this in. So let's say we are okay with understanding equity now, right? We understand that equity is the money that the business owners, could be you who came up with the original ideas, could be some other people who banded with you when they heard about the idea, or people you pitched, is that money they originally put, the money they put into the business, let me not use the word original, the money they put into the business, that's the equity, right? Now, when you all put money into a business and the business is a going concern, the business can be growing your money. That's why an outside person will want to put his money into your business. You must have proven to the person in a very convincing way that the money is putting in, the X amount of dollars is putting in, is going to grow to Y amount in some few years, hopefully. So, which means that truly, mathematically, that equity position can grow. So what makes it go up or go down? It can also be depleted anyway. If the business is not doing well, it can keep. That was what some people said about Uber. That, you keep the guys who keep putting more money are the ones subsidizing for the users. So they say the business is making losses and they are kind of like funding you to use the service. That if the service was really charging what we make them to break even, right, you'll be paying more than what you pay to use Uber. So there's so many ways people try and explain this in the newspaper to normal people, but the key thing is equity can go up, can go down. That you put in, all of you put in 50 million USD in a business does not mean the 50 million stays the same, forever, right? If the business is profitable, that money keeps growing up by the virtue of what I have explained here, retained earnings. So the profit the company makes, it keeps piling on top of the equity at the start of the period, and it becomes the closing value of the equity. So equity can grow and can come down. Now, equity is always captured in the balance sheet, okay? So let us quickly take a look at one such example. So when I say it's captured in the balance sheet, this is a very clear way of you seeing that in the balance sheet, there's always an equity line, right? That is usually, if you minus the liabilities from the, let me just do it quickly for you. If you minus the total assets from the total assets, you take out the total liabilities. You take out the total liabilities. Where is the other liabilities? You find out that what you get will always be equal to the equity. So let's not even worry ourselves about the mathematics. Just know that you will always get the equity from the balance sheet. Clear? Now let's talk about the, maybe since, let me look at my time. Okay, I'm not too far behind. Let's pull up an existing company, and then let's take a look at how the equity is represented in the financial statement. So I usually use a lot of Nigerian firms. Maybe today, if I can find a foreign company to use for us, that would be another nice one. Otherwise, I'll just go ahead with whichever Nigerian firm I have already. Okay, not a problem. Let's just pick one that I've seen here. It's Lafarge, and I'm going to just scroll to where we will see the balance sheet, and then you will again see what I said, that whenever you check the balance sheet, you will always see the equity position. So once I explain that, we are now going to talk about the different types of equity, the broad categories, which are two: ordinary shares and preference shares. So let me just try and scroll faster. Okay, so this is the balance sheet statement of financial position. So you see what I've mentioned, right? That you will always find it there. You don't need to do any calculation. There's usually no argument about what the equity is. You will always find it in the financial statement. Clear? So now let's move on to the different types of equity. Okay, so let's move on to, we have ordinary shares and there are preference shares. Okay, so again, what is the difference? Okay, all right, so ordinary shares is the, sometimes it's called common, so it's the common type. It's just very straightforward, you know. There are no guarantees. How do they spell guarantees? I hope it's double ES. There are no guarantees embedded. Just the usual best effort to pay dividends. So it's just the usual best effort to pay dividends. Okay, so that's the common type. And then usually too, it is the one I may be careful in writing this, so I'll tell you why I may be careful, but let me still write this. It's the one that can be easily traded. Let me use that word. That is often, it is the one that is, yeah, that's the better way. It is the one that is often allowed to be traded. It is the one that is often allowed to be traded. Okay, so I'll come back to that. I hope you see my handwriting. I hope it's not that terrible. It's not easy writing with your finger on a screen. Unfortunately, if I write on a whiteboard, which I don't have, you will probably not even see what I'm writing. So this is still the best. So let me read it in case you didn't see what I wrote. Ordinary shares is the common type. So sometimes you can call it common shares, right? Or common equity. There are no guarantees embedded. I will explain what I mean by guarantees. There are no guarantees embedded. It's just the usual best effort that will pay dividends. So a company can say, you know what, as management, we're going to try our best to do a dividend payout rate of 30%. So we could say, oh, you know, we are going to try to pay 30% of net income, you know, net income, let's just call it profit after tax, as dividend. So it's always a best effort, and some companies try to give a signal, especially publicly traded company. They try to give a signal of, oh, we normally pay 30%. So I think Zenith Bank is one such company. So every year, when you take what they pay as dividend and you compare to their earnings, you will see that it fluctuates between a particular, we call it dividend payout ratio. So they kind of try to keep to a dividend payout ratio, but it's best effort. The year GTB used to do that too, but I think this year they didn't really do that or something. So some years they can decide not to. So it's just a best effort. So that's why I put here best effort, right? Now let's talk about preference shares. So preference shares always come with some guarantees embedded. You know, I have some guarantees embedded, right? And oftentimes you need to convert it, need to be converted to common shares or ordinary shares / ordinary shares before trading. Ordinary shares before trading. Okay, so that's why I said that the common shares one is the one that is often allowed to be traded. I'll give you an example. So in year 2000 and I think it was 2006. So I was trying to buy First Inland Bank, FinBank shares. And then they had two options. They had the preference and they had the ordinary. And the ordinary, right? They were both selling at the same price. But you know what was different? Let me tell you what was different. So what was different is that the preference shares had these conditions. So they were going to pay me 7%. I might be wrong about remembering the exact percent, right? So just that's inconsequential. She says he can't see my screen. Is that general? Is it that nobody else too can see my screen, or is there someone who can see my screen so we can troubleshoot where the error is coming from? Can anybody help me out? Is there anybody else who is not seeing my screen, or can somebody confirm if they see my screen? Oh, awesome. So second person, one more person says he can't see my screen. Mr. Frank, you want to say something?
Yeah, I can see you.
You can see my screen. Okay, yeah. This is what I will do. Since two people say they can't see my screen, I'm going to reset my sharing. So I'm going to stop sharing, then I'll start sharing again. And then let's see if that helps. So I'm going to stop sharing my screen. Stop sharing. And then I'm sharing all over again. Okay. So how about now? So Mr. Matthew, Mr. Shei, can you check, is it visible now? Okay, that's a sad one now. You missed it quite a bit. Okay, it would be a good point to just do a quick recap of what I've done so far. So what we are following is this structure here. So we are still on number one, which is what is equity. I started with what is equity. I explained a lot about that. Then I moved on to different types. There's generally ordinary shares and then preference shares. So let me just take you through the notes quickly. So equity is the money that investors, owners put in the business. So I said, just to be technically correct, equity investors, because some people will also consider those who give you money as loan as also investors. So we have two types of capital sources for every business. There's the equity and the debt. But then typically when people talk about investors, we are talking about the people who put in money as equity. So I mentioned that equity can go up or go down. And then when we say go up, what it means is if the company is profitable, your equity will keep increasing because there is what we call retained earning. The profit they made after a period, they transfer it into the equity. So the equity keeps growing. And if they are making losses or something happens really bad, that they need to draw upon the equity to fix, then you find out that your equity is going down. And then I say equity is always captured in the balance sheet. So that one is very straightforward. You take a company's balance sheet, you will see the equity position there. So then I moved on to, there are generally two types of equity. There's the ordinary shares, so also called the common shares, but it's the common type. It's the one, if you buy into any company's shares online, I mean, via stock market, that's the word I was looking for. You are buying ordinary shares. There's no confusion about that. So all the shares you buy on the stock market, they are all ordinary shares. So that's why I even said it is the one that is often allowed to be traded. Okay. So then also too, it comes with no guarantees embedded. There are usually no guarantees with the ordinary shares. With the, it's best effort. Whether you will get a dividend is predicated, is that correct? It's predicated on the fact that, well, maybe they made profit and the management thought it's good to give you dividend. There's nothing binding them to giving you dividend. So then that was what I was trying to explain. Sometimes some companies try to give a signal of, we will always pay 30% or X% of profit as dividend. So they call it dividend payout ratio. So if you know that a company usually does that, you can even be able to estimate what dividend you will get ahead. So sometimes, like when I was doing my exam for the chartered stockbroker certification, or what do you call it now, to become a chartered stockbroker, this was part of what we had to do. So anyway, moving on, there's also preference shares. So preference shares comes with some guarantees embedded, right? So, and oftentimes there is the condition that if you want to trade it, you need to first convert it to common shares. So I'm right now trying to give an example. In year 2006, this is real life, not fictional, right? So I wanted to buy into Finbank on the same prospectus. I think it was an IPO. So there was a prospectus, and then so they mentioned that they are selling two categories of shares. There was the preference shares. So I was now mentioning what were the preference shares came with conditions. They were going to be paying me 7% preference dividend. Preference shares dividends. Sometimes you call it preferred dividend. So the grammar means the same thing. Preferred dividend. What that means is if I buy 1 million naira worth of that, value of shares, every year they're going to give me 7% of that my 1 million naira. They are making that guarantee. Well, there is that soft guarantee because again, I think there are some terms they also put about it. So that's that. Then they also mentioned that I'm not able to convert it. I can't convert, I can't trade it, can't trade or convert to common shares for the next, I can't remember the exact years, but let's say for the next 5 years. So they also said I'm locked in for the next 5 years. I cannot trade it, I cannot convert it to common shares. So they now said, after 5 years, I can convert to common shares and trade it. So those were the conditions that I remember were attached to it. So that is one thing about preference shares. Preference shares come with a kind of, as if you are buying, it's almost like a hybrid. It's like you want to enjoy the both world. You want to be able to benefit from as a normal equity investor, and you want to take some guarantees like a bank borrowing the business money. So when bank borrows the company money and they say, what, we are giving it to you at 20% interest rate, 15% interest rate, what they mean is every year they're going to be collecting that money, that 10%, 15%. So you too, as an investor, if you're going for preference shares, it means that you want to be getting some kind of fixed income, something that every year you're going to be collecting 7% of that your original investment as a kind of fixed income. But then you will not be able to come back and say, give me back all my money. And then based on what I wrote here, I can't even trade it for the next 5 years. Then if I want to trade it, I will have to convert it first, which has a process. I will have to convert it first to common shares before I can be able to trade it, okay? Now, let's talk about the ordinary shares. So for the ordinary shares, it doesn't come with any of all those, it's just the normal shares. That's the best way to put it, because that's what you see usually everywhere, So now, practically, so this one can be traded easily. And what other thing will I mention about? Well, it's the usual one. Let me just say it's the usual one. Okay, so, and then practically, what have I seen as differences? Okay, so what I have seen as differences is this. I work remotely for a startup, I say for example, for a private equity firm, and there have been times when they want to raise, they want to invest in a company, in a startup, and you know what? So they could be like, we're going to put in 500,000 euros, but we're going to put it in as preference shares. So why are they doing that? Preference shares gives them some protection. When you invest in a startup, so when you invest in a startup, you cannot really, it's difficult. It's difficult to exit via trading. So it's difficult to exit via equities trading. It's not like the startup is listed on any stock exchange that you will now be like, oh, today I feel like selling 1,000 units of my shares, and then maybe tomorrow or a week after you feel like buying back 500 shares. So for a startup, that can be very difficult. It's just difficult for that to happen, right? So number two is you can be locked in for a long time. So you can be locked in for a long time. So what they do is one way of at least getting back some of their money. One way of, because as a private equity firm, as a PE firm, as a VC firm, you also need income, right? You can't just be putting money and like putting money in different places and not think of how you're going to cover your own admin expenses, and also at least try to get back some of your money on time, so you don't just have money all locked away for God knows when you can be able to exit, right? So when you do as preference shares, without you losing the equity side, losing your percentage of ownership, losing whatsoever benefits will come as the company keeps expanding and raising new funds and the whole value of the business keeps growing, without you losing that, you can say, okay, I'm going to do this at 5%, preferred dividends. Preferred dividend yield, which means that every year you're going to be getting 5% of your 500,000 euros. You're going to be getting that, and that becomes some source of income. That becomes a way of you eating your cake and still having it. So that's why with private equity, VC, so when it comes to PE firms, VC, angel investors, they like this one. They like preference shares. Okay, so it gives them some protection. It gives them some way of getting back some of their money early on in the whole startup investment cycle. Okay, so clear? And let's see, is there anything I need to say about here? All right, so how are they modeled? So we have done this. I hope now nobody should be confused about the difference between ordinary and preference shares. So if you have any questions, you can always signify and ask. So I'm going to now move on to how are they modeled. The modeling is really straightforward. So let me take you to where I have it in mind. So preference is senior. Even from the very word preference, you can assume that it is a senior kind of shares. So this is how it happens, right? In the place where we model this equity, so we say, okay, how many ordinary shares do you have in your books? That's the closing value. What you had at the beginning of the year, did you raise any new shares? And then you get the closing value. The important one is the closing value, okay? The closing value is the important one. Let me just color it differently. And similarly for the preference shares, the important one also too is the closing value. So at the end of the period, how many people have, or how many preference shares do you have already issued, right? So now the thing is, when you for preference shares, right, there will be already the dividend yield you have committed to, right? So if you are committed to paying a dividend yield of, say, you started having a preference share by year 2021, I have committed to paying a dividend yield of 5%, right? So what happens is that let's even start here. So let's say we raised I just pray I don't save this. Let me just, because this is a live training material. Let me demo, save it somewhere else. Otherwise I'll be in soup. Okay, great. So let's say that we had in the first year, we had ordinary shares issuance. So we raised money of 500,000 naira. Okay. And for preference shares, we raised 100,000 naira. Okay. So what happens is this. So what happens is, let me see how many things I should just delete, take out. First, so let's take out everything so that you don't get confused. So let's retrace our steps a bit. Okay. Okay, great. In fact, let's say this is year 2021 and this is year 2022. 2022. Okay, so I want to show you how all of this can be very easily calculated. So you started a business in year 2021. What does that mean? You started with, at the beginning of the year, the business was not existing. During the year, you guys put together 500 million naira to start the business. So what does that mean? At the end of the year, the closing value of your equity is what you had at the beginning plus what you raised during the year. So, and then the opening next year is going to be closing this year, right? So you see, this is very straightforward to do. We just drag that, and then always your closing any year is always your opening plus whatever you raised, right? So I can easily drag this also, okay? So anytime you raise new money, I just come in here and say, oh, we raised additional 100 million naira. Boom. And you see it keeps reflecting in how much we raised, okay? So good. Now, this is the money that we raised. The money, remember I told us that the equity is the money that comes from the investors. So if we go back a bit here, you'll find out that what I've just written is a very explanation of what I have explained here. The money that the people who started the business or people who are like investors, equity investors into the business put in. Clear? So now, remember I mentioned there are two kinds of equity. There is the ordinary and there is the preference, right? So let's say we were able to talk some difficult people into putting money in, but because they are difficult, like they didn't trust us so much, they decided they were going to put the money in as preference. So again, before the business started, we had 0. Then during the year, we were lucky we were able to raise 100 million naira from these guys. I know but they decided to put their money in as a preference share. So what does that mean? It means at the end of the year, it would be how much we had at the opening plus how much we were able to raise from these different people. Clear? Okay, great. So as usual, next year's opening is going to be this year's closing. And whatever it is for the closing is always going to be the summation of the opening and the addition. So you find out that it's the same logic. I just say opening is always equal to last year's closing. And if we raise new money, I come in here and I put it, we raise new 50 million, so you see, same pattern. Okay, so now that we are done with that part, the next part is, so when the company makes profits, because that's the truth, your equity, remember I explained to us that it grows, it can go up and it can come down. And what's the difference is retained earning, right? So let's say the company made some profit. Every year, let's even put it on a very easy to do way. Every year, the company makes profit of 100 million naira. Now, if the company has committed to paying the dividend guys a 5% dividend yield, what that means is that preference dividend is always going to be equal to whatever the money the preference shares guys have invested times whatsoever dividend yield has been agreed upfront. Okay, so that is something you have to pay them for certain, right? So we pay them that, they take their own cut. Then from there, we will now have what is left for the ordinary guys to be able to share from, to take from, right? So that's going to be equal to the original profit minus what you have to pay to sort out the preference guys, right? And then if we drag this, it does likewise for, so if there was a year that something is looking odd here. Okay, we raised more money. All right, so I was wondering why is it so great. And then for the ordinary shares guy, what have you as management agreed on to pay them? It can be an agreement that you make that very year, or an agreement that you guys have made ahead and say for the next 5 years, we're going to be paying 20% of our profit as dividends, or you don't know what you will pay next year, but you know what you will pay this year. Whatever this case is, you put in that figure. So let's just say for ease of computation, the company has agreed to always pay half of their profit as dividend. You know what that means? 50% is what they have committed as their dividend payout rate. They will always pay half of the profit to the equity guys, right? So what that means is that the money that is left, net income that is left, for ordinary shares guy, times the portion we're going to pay them as dividend, and boom, that gives us how much we're going to pay as dividend. Okay, so I'm just going to drag this. and voila, done, right? So now what happens is, remember what I told us. I said that what makes the equity go up or down is retained earnings, right? So now we have come to that. So retained earning, when you start a business, you will not have any retained earnings, so zero. Then whatever profit you made at the end of the year, your net income, right? Then when you minus what you had to pay for the preference guys, and you take out also too what you had to pay to the ordinary share guys as dividend, then you'll be left with what you now have to, in fact, to add to the equity guys as, okay, this is how much your money has increased, right? So that's going to be equal to the opening plus the profit that we made, remove from it the money we have to pay for preference, remove again from it the money that we paid as dividend out. So all of that gives us, what is now the closing retained earnings, right? So if you look at it, it becomes a case where if you are doing the equity schedule, it's now going to be equal to share capital, retained earnings, and then we're going to have the closing equity. So the closing value of equity. So this is going to give us the equity anyway. So let me drag all of this. We always know that the opening is always equal to last year's closing. Okay, and I can just drag all this, right? So you see that as long as the company is profitable, the equity position will always keep growing. Why? The equity will always be, you take the retained earning and you add on top of the share capital. So let's do that together. So if I take the retained earning, so the share capital is simply this plus this, all of the money we raised directly from investors. That's our share capital. And then the retained earning is the closing value of retained earning. And then the closing equity in a simple company, is going to be just the summation of these two, right? So I can just drag all of this, and you find out that now we have how in a company the equity can grow and how it is computed, right? So this is that equity line. Okay, so I hope this is clear, because now I'm going to move on to the post-money and the pre-money explanation. So let's go now here. We are done with equity. Now, what is valuation? Valuation is the value of the business. It has nothing to do with equity. Valuation is the value of the business. And there are many ways valuation is being computed. So you can use the DCF approach, discounted cash flow. You can use the comparative company comparatives. Or we are using valuation multiples.
And there's no question that it's understandable why people are wary of the Republicans who pass it.
I think someone is. All right, so there are many common ways, right? Let me just say other ways. So there are many ways that valuation can be, determined, right? But as like I told you, usually it has nothing to do with your equity. Okay, so the only way that I know maybe which nobody will advise you to do is when you do book value. Book value approach. That's when valuation equals your equity position, and everybody nowadays agree that that is not a good way to value a business. Okay, so now remember what I said. Valuation is the value of the business. Sometimes we call it the enterprise value of the business. Enterprise value of the business or company. Okay, so how do we come about it? If we use the DCF, boom, it's too long for me to explain here. So let me just grab what I had used there. So according to DCF, this company is worth this amount. Is this billion or trillion? Billion, 3 point something billion. Like I told you, I'm not going to be explaining that one right here. So say we use DCF and it says this is what the company is worth. Okay, but this is what is commonly used. So I'm going to focus more on this one. This is what is commonly used for startups. And when people start talking about pre-money, post-money, a lot of times we are all usually talking about this. So imagine that the industry valuation multiple, maybe this company is a fintech. That's what is raining now. It's a fintech, right? And the valuation multiple, let's say the valuation multiple is 20 times net income. Let's say that's the valuation multiple. Valuation multiple is 20 times net income. You know what that means? It means that the value of this company is going to be equal to 20 times its current net income. So if you are trying to buy the company right now or value the company right now, it's going to be equal to 20 times the net income. What's the net income? This. Okay, so it can be something else. You know, it can be why it can be 60 times the or let's say it can be 2 times the transaction volume. It can be 5 times the EBITDA. It can be, you know, it can be anything. It can be $10 per active user. So that's why they call it valuation multiple. It can be anything that the industry feels is reasonable. There's no one committee that decides what it is, right? You just need to use what everybody's comfortable with, right? Because there has to be consensus. If you price something and the other party is not agreeing with it, you trade with yourself. Maybe you sell the business to yourself. All right, so back to, let's now use this. So now let's talk about what is pre-money and what is post-money valuation. What is pre-money? What is post-money valuation? Okay. All right. So let me take us to school. I'm going to change my. Let me see if I have Kindle here. Okay, I think I have. Remember I told us, I said it will get to a point where I will bring in some people who know more than me. You know, so let's look at people who this is what they do for a living. They've been on both sides of it, both sides in terms of them raising money and them being people giving people money, right? So no, don't deregister my, wow. Says they've deregistered my. All right, not a problem. I'll swap the screen share. Okay, so are you able to still see my screen? Good. Move here. So there is a book I have by, let me copy the title and show you why this book is an authoritative book on what I want to explain to us. Raising venture capital for the serious entrepreneur. Raising Okay, so you see this book, huh? Let me see if there's a place where you can see the ratings and all. Anyway, because of time, let's not overflog it, but you see it's a very highly recommended book for investors to understand how these pre-money and post-money things and all of the things that go into raising venture capital, right? So I have it open here anyway. So how is it computed when it comes to you are raising money and then they start talking about pre-money, post-money? Let's read it together, right? I don't have the thing that makes my screen to be to zoom. So let's see if I can. But can you see what I have on my screen? Is it something you can manage to see? I don't, and let's try something like this. Maybe that will work. No. All right, I'll read it for us. So, percentage ownership of a company granted to the investor, right? Now, the level of ownership assigned to an investor is a function of the amount of investment and the valuation post-money of the company agreed to by the investor and the entrepreneur. So now, the key thing I want to get out is what ratio everybody will own is based on the post-money calculation. I will explain later. But the truth is this: whatever you will own at the end is going to be tied to the situation at the post-money stage. But then let's go on. You know, agreed by the investor and the entrepreneur. So if the investor puts up an investment of $1 million and the post-money valuation is 40 million. So you know what that means? 1 million all over 40 million equals 25%. So that's what I mean by the eventual percentage ownership is always based on the post-money. I need you to remember that because people can throw these things around in such a way that you get confused. Even if when you read online, the way two different people will explain it, it will be as if they are saying opposite things. So let's just follow me. So remember the calculation of what every party is going to, if you have a capitalization table, the calculation of what everybody will own at the end of the whole transaction is always based on the post-money value. Great. So now the pre-money valuation ascribed to a company is the valuation of the company excluding the capital that is about to be invested by the investor that you guys are talking with right now. Okay, so the post-money valuation is the valuation of the company that includes the capital that is to be injected into the business. So you're into a fundraising round, and you see if you are raising 10 million USD, then the pre-money is simply what you have minus that, at the end of the day, what you are going to be valued at minus that 10 million that you just raised. So that's what is explained here. The value. Apologies. So backup fail, everything. Let me just check if my video and all this. Okay, great. I think I'm back. All right. So going back to sharing my screen, I can see some questions that popped up from your experience, buddies. So I'm going to come to explaining how these all work. But first of all, let me try to finish up the explanation. Then I'll show you some of the calculations. First of all, can you confirm to me if you can see my screen? You're offline. Can you see my screen? My monitor, the other place where I'm monitoring what is happening is affected. I can't see what's happening there. But can you see my screen? Should I continue and wrap up? Are you able to see my screen? So once you confirm that you can see my screen, then I think I'm good to go. Let me just check. I think, okay, my other environment is coming up right now. Let me just go back in. Okay. All right. So on my own side, I think I can see on my second device, I see my screen. Oh, is that correct? Okay, great. Oh yes, someone has even replied. So let's quickly wrap up the explanation, right? Pre-money is what you are valued at minus the money that they put into your business, right? Okay, so what you are valued at includes the money that is being put into your business at that period, right? So again, when we do the mathematics to become clear, so the money valuation minus the right? So this is where the that screen, since that's where I have the calculation of all done. So let me just switch back to the other screen. So stop sharing this one, then I'm back on the other screen. I hope you can see the other screen. Looks like it's not up. So click one more thing. Are you able to see Can you see my screen? Let's now bring all of these to reality. Companies do these. At least I work for remote, the venture capital, also to some clients that are angel investor or who wants to put in let's see, this is 2 billion, right? What is a quarter of 2 billion? That's 500 million. Wants to put in 500 million at 500 million for at Premoni valuation of 2 billion. Okay. So all this grammar I've written, how does it play out? You can't see my screen anymore. Let me reset it. Okay.
All right.
Okay. So is this back again, right? Oh, thanks for notifying me on time. So I want to explain the difference between pre-money and post-money. So let's start with pre-money. If an investor says, so we are using Premoni as investor right now. So let me put it in a very visible color. Angel investor Premoni wants to put in 500 million naira for 20%. Normally, when investors want to invest in your business, they usually will tell what percentage they want. In fact, if you want to get into Y Combinator, they tell you that we're going to give you, I think whether it's 20,000 or is it 100,000 USD for 7%. So it's something that it's part of what that's their normal speak. I'm going to give you X amount for X percentage on ownership. So that normally just comes with it. So it's not a problem of what if they did not say how much they want to take as equity, or they will always say at the end how they come about that number different ways. You can want to negotiate it, but at the end of whatsoever you guys are concluding, it will always be that the investor wants to put in X amount of naira or dollars for for Y percentage ownership. Okay, so where it can be different is this last part. It is that last part that can be different. Is it going to be pre-money or is it going to be post-money? So let's see what happens in pre-money. If the angel investor says, I'm going to put in 500 million naira for 20% at pre-money valuation of 2 billion, you know what that means? It means that remember the formula. Pre-money or the explanation will be hearing. And remember what I said, that the percentage are ownership or equity share is always computed at post-money. Is always computed at post-money. Computed at post-money. Right? So if you remember these two things, that's all there is to get the mathematics complete. So what that means is we always need to calculate the post-money, because that's how you will know how everything will end. Okay? So now take a look at it. For now, we have how many shares? We have 600 shares. Let's say all these shares are at 1 share per. Let's just say these are shares, 600,000 shares. So if we have this as 600,000 shares, right? Then what that means is that if we are valuing a business at 2 billion naira pre-money, right? It means the share per the price per share is going to be equal to this divided by the number of shares. So again, I'm just using this tentatively as number of shares that we are saying the shares are nominally. In fact, to make life easy, let us use something that rounds up to a nice figure. Let's say there are 500,000 issued shares. And this is pre-money. So the share price, maybe I should let you know, the share price is always calculated pre-money. Share price is always calculated pre-money, which means the pre-money valuation divided by pre-money shares outstanding. So maybe let's just say there are 3 things you need to remember all the time. So these 3 things, 1, 2, and 3. And with those 3 things, there is nothing you're looking for you will not get. So let's see how all of these become really different. Let's start with what is the number 1. So let me take this, paste it here, and say this is case 1, right? Case 1. And this is case 2, right? So we're going to do case 2 also. I hope I'm really running against time. I'll be faster now. So we're going to do case 2 also. So great. What do we need? What are the things we need to calculate? Number 1, we need to calculate existing investor, we need to calculate share price, we need to calculate existing investors equity share, and new investors equity share. Okay. Okay, so let's start. If I change this to 500,000, it's not too difficult. I can just come here, great. I can come here and say 500,000 shares divided by, so this gives us the share price. So this is the share price. This, or price per share, this is fixed, right? So if the share price is fixed, right? So now what is the implication of we want to invest 500 million naira? Let me just tweak the change a bit and see, and let's start from gradually here. I was almost roasting. Let's start with this, and then you see how we can gradually build up to it. So if you want to invest 500 million naira, we are valuing the company. This is the company's value. We are valuing the company at 2 billion naira. Now, this can be pre-money or post-money. This can be pre-money or post-money. So that's where we are starting with. Let's even start with, we are valuing it at 2 billion naira pre-money. So how then do we calculate what goes to who, right? So what that means is this. Before investment, after investment.
Very good. This is past 3. This is past 3. Like, mhm.
Mic check, Marco, you're muted. Can't hear you.
Jeez. Apologies. Thanks for mentioning that. Okay, so
We go run on now.
let me
We
just
go run
restart again.
today. Okay, so this is it, right? My people are back.
Okay. So remember I said share price is always calculated pre-money. When the pre-money was 2 billion, then it was the share price divided by the number of shares gives us which actually is 4 naira per share, right? But then when the money is post-money, we need to go and get out the pre-money first. So we need to get the pre-money. So the pre-money is going to be equal to the 2 billion minus the investment amount. And then that is going to be what the share price is going to be computed on. So the share price is going to be equal to this divided by the original shares outstanding before the whole money came in. the pre-money shares outstanding. Okay, so you'll see in this case the share price is already looking different, right? 3 naira. So for here, there's going to be share price 3 naira, share price 3 naira. Okay, then the existing investor, they had 100% before investment. These guys had 0%. Okay, and then this is the easiest part for post money. Post money, you are just simply taking whatever money they are putting in, which we all know they are putting in 500 million, and you are dividing that money with the entire post money valuation. That's why I say this one is very straightforward when it comes to percentage ownership. Percentage ownership is always the post money is going to be used to divide the amount of investment. So this one will show you how much they will get, right? This is for the guys coming in. And then the guys who are there before, what they will have as their own portion. So you can see how the same amount involved, but just difference between one is pre-money, one is post-money. And you see that if you are the investor, case 2 favors you, favors the investor. Case 1 favors the existing or the owners, existing owners before the new investment. So that's how usually you find all of this. So you will notice that a lot of times when VC firms are going to invest in your business, so they will tell you, they will say, you know what, we are valuing your business at this amount, but we are doing it on a post-money basis. Why? Post-money favors them. They're going to get a higher ratio of ownership. And then if you are smart, then you will try and push that, you know what, let it be a pre-money valuation, which favors you, because you're going to get, it will make you guys reach a higher nominal share price, and also it will let you have a higher chunk of the business. So it depends on who can do more. But then even if you cannot, because maybe the investors, typically investors will be bigger than you on most cases. So you find out that there is very little much you can force them to do against their will. But there's something else that you can do that everybody understands. So if you guys have an options pool, you know, where you guys are setting aside some equity for future employees, for stock options. So it's always best that you try to set it, you try to do it in such a way that it comes to play after, so that you don't see your own portion diminish drastically, right? So again, I don't want to go into that, but there are so many angles to it that once you understand this, there are many ways to still try and push something that is not going to work in your favor, try and push it a bit to your favor. But then let us recap. 5 minutes recap. Question. Investor A puts in 1 million at 4 million post-money valuation. What is the percentage ownership for investor A? Anybody want to give it a try? Does anybody want to give it a try? What would be the answer to this question? based on what we've said, based on all what we've done, what do you think? Investor A wants to put in 1 million naira at 4 million post-money valuation. Anybody? Okay, let's see. I think some people have typed in their answers. Okay, maybe I was guessing wrong. Yeah, anybody wants to give it a try? What do you think the answer will be? Please just give it a try. Investor A wants to put in 1 million at 4 million post-money valuation. What do you think the answer would be?
25%.
Let's check. So how do you check? Percentage ownership or percentage equity you will give to give the new investor is always equal to the investment divided by post-money valuation. So you are correct. It's going to be equal to the 1 million divided by the 4 million post-money, 25%. Always that straightforward. That's why I say everything boils down to these three things. So it's just for you to know how to calculate what you need in case the English changes. So now, what about question? Same situation, but what will be the share price if the pre-money, sometimes they might not tell you that the pre-money, they might just say the existing shares outstanding, but let's just write it complete. What if the pre-money shares outstanding is, let's use a round figure, 500,000 shares. So what do you think? What will be the share price? What do you think will be the share price? So what's the share price? I want to give it a try. So let me tell you the advantage of this share price. Naturally, for a business that is growing, the share price will keep increasing. If you raise money at 4 naira per share, if that's what the share price came to this year when you raise money, if you're raising money 12 months after and you have been growing, everything about you has grown. Number of users, number of transactions, number of profit and all of that, they've grown, right? You're not going to fix the same share price next year. So that's how you will find out that when you fix the share price next year, it can be a very quick way of coming to what your valuation will be, and then you raise money again next year. And people will not argue when you say, last year we were valued 4 naira per share, and we have done 4 times what we were last year. So obviously our share price is no longer 4 naira, it's now 20 naira or 16 naira, So which means the whole stuff grows, right? The whole, what's the word now? The whole pool of money, everybody involved. So anybody wants to join you guys that next year, it will be coming in at that price point. But then you need to know the share price. So what's your answer? Anybody wants to give it a try? Well, we are wrapping up. Have another session coming up in about 30 minutes. Anybody going 1? Going 2? Anybody? Yeah, somebody please. Okay, I will answer for myself then. So you need to know what the pre-money valuation is. So the pre-money valuation is going to be equal to the 4 million minus the 1 million, which is 3. And then the share price is going to be equal to that pre-money valuation. So that is this 3 million is in million. So divided by the 500,000. In fact, let's just say this divided by the 500,000. 500,000 is 0.5. So share price is 6 naira. Okay. So or $6. If that's the word, in this case, it will be $6. Okay. Yeah, $6. All right, so valuation in million. So that brings us to what's the other thing people like to calculate, which we've already done. These are the three things: the pre-money valuation and the percentage that goes to the new person coming in, which will have to come out of the old people's percentage. So that's it. I'm sorry, it might not have been as smooth as I didn't think it would take this long to explain. Otherwise, maybe I would have cut down on what I spent on equity. But then again, I might try and do another day that will just be on this, so we can do a lot more example. But at least everybody should be clear about what pre-money means, what post-money means, and then the calculations that are always done. If you want to come about the share price, it's always calculated at pre-money value and pre-money shares outstanding. If you want to calculate the percentage that will go to the new equity, guys, always calculated at the new investment divided by the post-money. And if you want to calculate the pre-money, it's always the post-money minus the new investment. So those are all the things that go into it. So thank you very, very much. Thanks for staying this long. And we will be having another session coming up in about 30 minutes time. We have someone from Microsoft who is going to be taking us on new Office scripts. So please join us. Let me quickly put the link and you can join. Oh, I didn't even see your answers, Mr. Sadiq. Sorry. So somebody has even been answering us. Thank you. Awesome. Your answers are correct. Great. So apologies, it wasn't popping up on my screen on the other side. So thank you very, very much. I wish I have a prize I would have given you, Mr. Sadiq. So, but have a nice day. I have to quickly run and set up for the new person. So bye and see you next week.